Hey everyone, it's Anthony with InTouch Mortgage Solutions on our Finance Fridays episode. Welcome back to the channel. On this week's episode, we're going to go off on a rant on inflation, what's happening in the economy right now. We're getting a lot of questions around what this means for Canadians and obviously how this inflation data can be digested by the Bank of Canada ahead of its meeting on October 25th. Many economists are putting an upside risk at the Bank of Canada having to increase at least another 0.25% at some point before the end of the year. Now, obviously, all those questions are still up in the air. Nobody really knows what the Bank of Canada will do next, especially when we hear that the U.S. Federal Reserve just this week kept rates unchanged. So they left everything alone. And obviously, this is a very important step and decision for the Bank of Canada. Even though the CPI inflation print came in at 4%, the headline inflation number came in at 4%, while the core inflation numbers are obviously on a trajectory upwards over the last months, we've seen things go up. And many Canadians will feel those pressures right away in the grocery stores, obviously at the gas pumps, and in many provinces with their energy bills for those Canadians that are heating their homes with oil. And these things are very expensive for Canadians, and consumption is important, especially as we enter into the colder months. So what is happening over here with inflation, the data? Obviously, first and foremost, what's happening with mortgages and mortgage rates? Well, it's all over the place right now. Obviously, we've been monitoring these fixed rate mortgages on the channel. And if you're new to the channel, we invite you to subscribe and hit that notification bell. So when we have our conversations about mortgage rates, you can get that notification. But with the data that came out on Tuesday with the inflation print, obviously it sent the bond market into a pandemonium. We saw all these bond rates, these bond yields skyrocket. And obviously that is correlated or very directly related to how many of the banks price in fixed rate mortgages. And if we see bond yields rise, well, fixed mortgages will obviously move with them, which obviously for Canadians who are renewing their mortgages, especially those fixed rate mortgages, well, they're going to be renewing into higher rates. Even Canadians with variable rate mortgages, whether they be adjustable or on a static payment, are going to feel those pressures if they're going to be renewing into a fixed rate mortgage, and they're going to have to snap back some of these amortizations from these to infinity and beyond amortizations that we saw surpass 35, 40, 50, even 90 years plus. Obviously, this is a big problem. Bank of Canada is fully aware of the current situation. Just on Tuesday, we heard from the Deputy Governor of the Bank of Canada in Regina, where there was like a press conference where they talked about obviously the supply chain issues that have occurred, wealth disparities between households when it comes to debt levels. And obviously there's a lot of questions around that, right? Because as we see consumer debt levels, expand or inflate here in Canada as a result of higher borrowing costs, well, that begs the question for the Bank of Canada, what does that mean for consumer spending? When people get tapped out, they can't borrow, it's too expensive. Well, obviously something has to give, something's going to break. And when we start to look at, debt to income ratios at 184%, this is a huge alarming data point for the Bank of Canada. Now, with that being said, I want to make it very clear that the Bank of Canada's mandate is to bring inflation to 2%. That is what they're laser focused on. Obviously, there's other data points that they're going to be concerned with. Yes, inflation, the CPI numbers, yes, they're ticking up, but they're also looking at the economy. They're looking at monetary policy and saying, hey, have we done enough? Is there enough done with increasing that policy rate to 5% and holding it there that these lagging indicators are starting to show signs that the economy is contracting and slowing down? Consumer spending is falling flat. We have, obviously businesses potentially laying off. We're seeing that unemployment rate tick up. Immigration's having a huge play on the labor market because as we bring in new to Canada individuals, well, they're going to enter the workforce, and that's going to basically put competition into the workforce that could bring down wages because a lot of companies were trying to hire individuals and they were just not finding the people to work at maybe specific price points, but they weren't able to find employees. So they had to raise the cost or the price per hour or wage or salary to basically entice these people to come and work. And with more new to Canada individuals, well, that could ease those price pressures. Now, you also look at, as I said, we talked about the vacancies, the job creations. As we bring in more people, we need to create more jobs. But if there's a lot of jobs that are not being filled, or there's basically too many people for the amount of jobs in the economy, well, then we're going to run into a serious problem. Most importantly, obviously, we talked about mortgages, the higher cost for Canadians to carry those mortgages, which in turn impacts rents, right? And we had this conversation, and anybody who thinks that mortgages don't impact rents needs to give their head a little bit of a shake, because if you're an investor, let's say, and recently we got data saying 30% of some of these projects, these homes, were gobbled up by investors, right? So this is a huge component. And you think about that, yes, that's an alarming number, but these investors who may have purchased these properties, maybe they have variable rate mortgages, maybe they have fixed rate mortgages, maybe they're in a condo that has rent control, doesn't have rent control. And rent control, that date, I believe, is November 15th, 2018. So if it's after that date here in Ontario, well, the landlord has basically free reins to increase rents to cover the cost of their mortgage. And that obviously pushes up rents not only in Ontario, but it pushes up the average across the entire country. And we're seeing those rent prices obviously skyrocket in places like the GTA, Vancouver, and most recently even in Calgary, right, where most of Calgary was generally deemed affordable. So when you think about all these things combined, you have to look at how inflation is really playing out. Wages, everything to come from, even consumer spending. When it comes to what we're spending on, when it comes to the groceries, right? Groceries are up across the board. And although we're seeing some moderation in some of these prices, arguably that's what Stats Canada is reporting, you have to take into consideration that the government is now trying to, stamp down on price increases, right? They're trying to stabilize these prices, and they just recently had a meeting with all the heads of the major grocery chains, trying to stabilize these prices in one way or one shape or another. And I hope that they have some success with this, but it's a very challenging conversation because they want to try to get these prices under control by Thanksgiving. Monumental task on its own. But obviously, what does that mean for grocery stores? Many of us may not have a lot of sympathy for the grocery chains, as they were definitely price gouging many Canadians when it came to certain items. But obviously, it begs the bigger question, right? As these fuel prices continue to rise, we have obviously the carbon tax, you have farmers facing higher costs. Obviously getting the product from the farmer's field, till that soil, diesel tractor, transport truck, food terminal, to the grocery stores, well, all that stuff goes up, all that stuff costs more, and at the end of the day, the consumer ends up paying more. Could we, reduce carbon taxes? Can we, bring back some of those Ontario credits for fuel? Like what's happening with oil? Because the Bank of Canada doesn't have control over the price of oil, and the fact that Canada produces oil itself is another question entirely. But obviously, we see red flags everywhere. And then we get into conversation, we've had this conversation before, is, what is the role of the government in this, right? When we think about how they, printed all this money, the government basically, all these stimulus that went into the economy, which at a particular point in time was probably required. How it was dispersed is arguably another question, but now we're paying the price for it, right? Canadians are paying the price. Maybe they're going to lose their homes, they're going to lose their jobs, they can't afford their mortgages. Like, this is really a big problem here in Canada. There's many different signals that are pointing us in the direction that Canada is in for some serious headwinds ahead. And obviously, the Bank of Canada needs to be prepared to address these concerns. I think that's the biggest component. And just to bring it for a full circle on inflation, recession, obviously this is very important. Why? Because if the Bank of Canada induces a recession to make sure that inflation hits 2%, they can walk it back by reducing interest rates, which can obviously stimulate the economy. The question is, when will we see that, or if we'll see that at some point in 2024 or 2025? We don't even know exactly when that could happen. So this is why many Canadians who are asking, what do we do when it comes to our mortgages, our renewals? What options do we have? It's getting a lot more challenging for Canadians to keep themselves afloat, and they're leaning on their debt instruments like lines of credits and credit cards to make ends meet. And that data is coming out from TransUnion and Equifax. And obviously, I just feel that the Bank of Canada really needs to be conscientious about the majority of Canadians that are in this particular circle. And yes, you have to take all that information and say, look, 2/3 of Canadians own their home. I think it's around 60% of Canadians own their home. How many of them have a mortgage? How many of them don't have a mortgage? How many of them have a very small mortgage? How many of them are impacted by higher interest rates? How many are not? And obviously, how this will play out in the next little while. But obviously, ahead of the Bank of Canada rate announcement, it's anybody's guess what could happen. But Let us know what you think about those rate predictions, or what do you think is going to happen in October or December. The US Fed held. What does that mean for Canada, the economy, the dollar? So many questions up in the air as we start to see all these things change in the market. But we'll leave the video here. Wishing everyone a wonderful Friday and even better weekend ahead. Thanks again for clicking. Thanks for watching. We'll see you next week.